I got a $20,000 raise last year, and somehow I ended up with less money than before. Not because I spent more, not because I made bad decisions, because the moment that raise hit my account, 4 different systems were already waiting to take it from me, each one quietly, efficiently, and without a single warning. And here's what really gets me. My HR department said nothing. My accountant said nothing. My boss shook my hand and said, "Congratulations." Well, not one of them mentioned what was about to happen to that money. So if you're watching this right now, chances are one of 3 things is true. You just got a raise, you're expecting one, or you got one a while ago and you're still wondering why it didn't feel the way you thought it would. By the end of this video, you'll have the answer. But I want to warn you that what you're about to see will permanently change the way you look at income. And that's not a bad thing, because the people who understand these 4 systems make completely different decisions with their money. And those decisions, compounded over time, create a financial picture that looks nothing like the average person's. Let's get into it. Let's set the scene. You've been earning $75,000 a year. You've been doing good work. Consistent, reliable, above expectations. One day, your manager calls you in, slides a paper across the desk, tells you the company values what you bring, and then says the new number, $95,000 a year. What goes through your head in that moment? $20,000 per year. That's $1,666 extra every single month. That's rent, that's a car payment, that's your kid's tuition, that's freedom. You drive home that night with a different feeling. Maybe you go out to dinner. Maybe you sit down and start doing the math. I can finally do this. I can finally pay that off. I can finally start building something. And right there, in that exact moment of celebration, those 4 systems quietly activated. While you were raising a glass, they were running the numbers. I'm going to show you each one. And as I break them down, you're going to watch that $20,000 shrink in real time. By the end, you'll know exactly what you're actually working with, and more importantly, what to do about it. Most people think about taxes like this. I pay a certain percentage, the rest is mine. That assumption is one of the most expensive misconceptions in personal finance. Here's how it actually works. The US tax system is progressive. That means not every dollar you earn gets taxed at the same rate. Your first dollars are taxed at a low rate. As your income climbs, each additional layer gets taxed at a higher rate. So when you were earning $75,000, you were sitting comfortably in the 22% federal bracket. The moment you crossed into $95,000, that extra $20,000 didn't start from zero. It stacked on top of everything you were already making and got taxed at the highest marginal rate that applies to your income. Let's run the actual math. Federal income tax on that $20,000 raise, approximately $4,400. Then comes FICA, that's Social Security and Medicare. At 7.65%, that's another $1,530 off the raise before you see a penny. State income tax varies by where you live, but the national average lands somewhere between $1,000 and $1,500. Well, add it up. Before you spend a single dollar of that raise, you've already lost between $7,000 and $7,400. What's left? Roughly $12,500 to $13,000. Now here's where most people stop calculating. They pocket that number, feel pretty good about it, and move on. But we're only through System 1. There are 3 more waiting. I want to introduce you to someone. Let's call him Daniel. Daniel works at a mid-sized software company in a mid-sized city. For the past 3 years, he's lived in the same 2-bedroom apartment, paying $1,200 a month in rent. He drives a paid-off 2018 sedan. He brings lunch from home most days. He cooks dinner most nights. Nothing glamorous, but nothing stressful either. His savings rate? About 18% of his income. Every month, without fail, money goes into index funds. Then he got promoted. Senior role, more visibility, more responsibility. His salary jumped from $65,000 to $85,000. Month 1, nothing changed. He kept his habits, ran the same routines. Month 2, but a thought crept in. I'm a senior employee now. I have client meetings. I should probably be in a neighborhood that reflects that. Rent went from $1,200 to $1,750. Month 3, his car needed a repair. I was going to replace it anyway, he told himself. he leased something new, $550 a month. Month 4, he joined a nicer gym, closer to the office. Only $60 more per month. "I deserve it," he said. And honestly, he did. By month 6, he was having lunch at the restaurants his colleagues went to, weekend dinners at places he used to consider special occasions. I work hard. I should enjoy my life. 1 year after his promotion, what was Daniel's savings rate? 4%. He got a $20,000 raise. His lifestyle expanded by $16,000. Net financial gain, $4,000 a year. Was Daniel irresponsible? No. Was he reckless? Not by any individual decision. But he was simply living out what economists call Parkinson's law of money. And nobody had ever told him it existed. The original Parkinson's law says work expands to fill the time available for its completion. The financial version is just as brutal. Expenses expand to fill the income available. Think of a balloon. Every time you add income, the balloon gets a little more air. And without a deliberate, intentional decision to stop it, it keeps inflating until it fills every inch of space you gave it. Daniel's story isn't a cautionary tale about one person's bad choices. It's a description of what happens on autopilot. And if you recognize yourself anywhere in that story, that's not a character flaw. That's the default setting. The question is whether you want to stay on default. This section is for anyone carrying student loan debt, and even if you're not, stay with me, because the same mechanism applies to other tax deductions you might be using right now. The U.S. tax code allows you to deduct up to $2,500 in student loan interest per year, but only if your modified adjusted gross income falls below a certain threshold. For single filers, that phase-out begins around $75,000 and disappears entirely above $90,000. Here's what that means for you. At $75,000, you were likely deducting the full $2,500. Now, that deduction was quietly saving you somewhere between $550 and $750 in taxes every year, depending on your bracket. At $95,000, that deduction starts phasing out. Cross the upper threshold and it vanishes completely. So here's the cruel irony. Your raise, the one you worked for, the one you earned, just made your student loan more expensive. You didn't borrow more. You didn't miss a payment. You simply earned too much to qualify for a benefit you were counting on. And here's what makes this particularly sharp. Nobody in the room when you signed that offer letter mentioned it. Not HR, not your manager, not the benefits coordinator. The system doesn't explain itself. It just adjusts. And the people who know about these adjustments plan around them. The people who don't find out later, usually at tax time, usually when it's too late to do anything about it. Now we get to the one that costs the most, because this system doesn't live in the tax code, and it doesn't live in your lease agreement or your loan documents. It lives inside your head. I call it the conformity tax. Here's how it works. The moment your income crosses a certain threshold, the story you tell yourself about who you are starts to shift. Quietly, gradually, but unmistakably. You're a senior employee now. You have clients, you have peers who earn what you earn and live a certain way. And without anyone explicitly telling you to, you start aligning your spending with the identity your income implies. A certain kind of car, a certain kind of neighborhood, a certain kind of wardrobe, a certain kind of restaurant, a certain kind of vacation. None of these decisions feel like status purchases. They feel like reasonable upgrades. They feel like you've simply arrived at the level you've been working toward. I'm not being extravagant. I'm just living appropriately for where I am. But let's look at the math. Going from a paid-off $11,000 used car to a $650 a month lease, that's $7,800 a year in after-tax dollars. Money that's gone the moment it leaves your account, building exactly zero equity. Upgrading from a $1,400 apartment to a $2,000 apartment because the new neighborhood makes more sense for your career, that's $7,200 a year. Gone. The gym upgrade, the grocery store upgrade, the wardrobe refresh, plus the dining shift, each one small, each one justifiable. Together, they represent a bill that most people never actually see because it never arrives as a single invoice. It just shows up slowly, month by month, in the gap between what you earn and what stays. Now, here's the part that makes the conformity tax especially insidious. Unlike the other three systems, this one makes you feel successful while it's draining you. When you're paying tax bracket penalties, you feel cheated. But when you lose a deduction, you feel frustrated. But when you upgrade your lifestyle, you feel like you've made it. That feeling is expensive. I want you to think about two people who received the exact same raise on the exact same day. Same company, same salary, same tax situation. Person A went home, updated their automatic investment contributions, and kept everything else the same. Person B went home, started looking at new apartments, test drove a few cars over the weekend, as in told themselves they'd start saving more seriously next quarter. 5 years later, those two people are living in completely different financial realities. Not because of talent, not because of luck, not because one worked harder than the other, because one of them recognized the conformity tax and chose not to pay it. Let's put all four systems together. $20,000 raise, one line item. Federal, state, and FICA taxes, minus $7,200. Student loan interest deduction loss, minus $600. Lifestyle inflation's conservative estimate, minus $8,000. What's left? $4,200 per year, $350 a month from a $20,000 raise. Now sit with that for a moment. What did you do to earn that raise? You stayed later, you took on more, you handled more stress, more responsibility, more complexity. Maybe you sacrificed some time that could have gone somewhere else. And the net financial difference in your life? $350 a month. Now I want to be clear about something. This isn't a reason to stop pursuing raises. It's not a reason to turn down promotions or coast at work. That thinking leads nowhere good. This is information, and information changes decisions. The people who know this number going in, they make the raise work differently. They capture it before the four systems can touch it. And the compounded result of doing that year after year is the difference between earning well and actually building wealth. And every person watching this video right now falls into one of two categories. Category 1, this is depressing. The system is rigged. There's nothing I can do. Category 2, okay, now I understand the game. Let me figure out how to play it differently. If you made it this far into the video, you're category 2. So let's talk about exactly what to do. Step 1, calculate your actual net raise and split it immediately. Before you change a single habit, figure out what you're actually keeping after taxes. Not the gross number, the real number. Then take a minimum of 50% of that net increase and automate it directly into investments before it ever touches your checking account. Set it up the day your new salary starts. The money you never see is the money you never spend. The remaining 50%? Yours. No guilt, no restrictions. You earned it. Enjoy it. But the first half is already working. Step 2, put a ceiling on lifestyle expansion. This is the one that requires the most intentional decision-making. In the month you receive a raise, write down your current fixed costs, rent or mortgage, car payment, subscriptions, recurring expenses. Then draw a line. These costs will not increase by more than a defined amount. Pick a number, maybe 10% of your net raise. Stick to it. This isn't about deprivation. It's about making sure that when your income goes up, your margin goes up with it, not just your standard of living. And step 3, use the raise to reduce your tax exposure. This is where the math actually starts working in your favor. Max out your 401k contributions. If you have a high deductible health plan, max your HSA. Both of these move dollars out of your taxable income before the brackets get to them. You're not avoiding taxes. You're using the existing rules to keep more of what you earn. And if you have student loans in the phase-out range, talk to a tax professional about your options. There are strategies, income-driven repayment structures, timing of deductions that can meaningfully reduce the impact. But you have to know the trap exists before you can navigate around it. Step 4, name the conformity tax before you pay it. The next time you're about to make an upgrade, a new apartment, a new car, a new anything, stop and ask yourself one question. Is this a decision I'm making? Or is this a decision the version of me I think I'm supposed to be is making? That question sounds simple, but asked consistently, it's worth thousands of dollars a year. You don't owe the marketplace a lifestyle upgrade every time your paycheck increases. Your net worth statement doesn't care what your apartment looks like. Your retirement account doesn't know what car is in your driveway. The only scoreboard that matters is the gap between what you earn and what stays. Here's the reframe that changes everything. Stop thinking about your income as a salary. Start thinking about it like a business and focus on one number: your operating margin. A business with $10 million in revenue and $9.9 million in costs isn't a successful business. It's a treadmill. A business with $500,000 in revenue and $200,000 in costs, that's a machine. Your household works exactly the same way. Yet you could be earning $150,000 a year with a zero margin. And I showed you earlier exactly how easy it is to get there. Or you could be earning $80,000 with a 20% margin and be building real, compounding, generational wealth faster than the six-figure earner who's leveraged to the ceiling. The goal isn't to earn more. The goal is to protect the margin. That margin, the gap between what comes in and what goes out, is the only number that buys you freedom. It's freedom to say no to the job that's burning you out. Freedom to weather a layoff without panic. Freedom to make decisions based on what you actually want, not what you can barely afford. Most people spend their careers optimizing for income. The people who actually get ahead optimize for margin. And here's the thing about that $20,000 raise. With the right approach, it doesn't have to shrink to $4,200. If you automate 50% of your net raise into investments, limit lifestyle expansion to 10%, and reduce your tax exposure through pre-tax accounts, that $20,000 can generate a compounding return that over 20 years at a 7% average annual return approaches $80,000 in real wealth. From one raise. Now imagine doing that with every raise, every promotion, every bonus. That's not fantasy math, that's the actual arithmetic of financial independence. And the reason some people who earn average salaries retire wealthy, while others who earn exceptional salaries retire with nothing. Income is the speed at which money moves through your hands. Wealth is what stays. The question isn't how much you earn. The question is, how much of it is actually yours? Let's bring it all together. When you get a raise, 4 systems activate simultaneously. System 1, tax brackets. Your additional income gets stacked on top of what you already earn and taxed at the highest applicable rate. First hit. Automatic. System 2. Lifestyle inflation. Parkinson's law of money. One, expenses expand to fill the income available, silently, gradually, and without a single deliberate decision. System 3. Tax deduction phase-outs. Student loan interest, certain credits, income-based benefits, they quietly disappear as your income climbs. Nobody sends a notice. System 4. The conformity tax. The most expensive one. The one that makes you feel successful while it empties your account. The person who knows about all 4 systems doesn't earn more than you. Why does they just keep more? And keeping more, consistently, intentionally, year after year, is the entire game. If this video gave you something useful, do one thing right now. Think of someone in your life who just got a raise or is about to. Someone who's about to celebrate without knowing what's coming next. Share this with them, because this information, delivered at the right moment, genuinely changes financial trajectories. I'll see you in the next one.